Inventory valuations, FIFO, first in, first out, and LIFO, last in, first out accounting. There's an important distinction I want to make here between the two methods, and that is the total amount of inventory, total dollar amount in this example is $3,700. And what's important to remember is that once all the units get sold, every unit, all of that $3,700 goes from an asset account inventory to cost of goods sold and expense account. The only difference in inventory valuation methods is the timing of when you recognize the expense. So there's other methods like weighted average, units of production that I won't do in this video, but that are out there. So let's assume no beginning inventory. Let's also assume, as is usually the case, that costs go up over time. So a company buys 100 units at 10 on March 1st, 100 units at 12 on March 15th, and 100 units at 15 on March 25th. So we've got 3 purchases. Then on the 30th of the month, they sell 150 units. The question is, what's the cost of those 150 units? What's the cost that gets moved to cost of goods sold? Okay, 2 methods. FIFO, first in, first out, meaning that the oldest units get sold first. So in this example, 100 units at 10 get sold, and then 50 of the units at 12 get sold. The total cost of goods sold is $1,600. So we started with the oldest and work our way down. 100 at 10, 50 at $12 for a total of $1,600. First in, first out, oldest units get sold first, and because costs are rising over time, the oldest units are the least expensive. LIFO, last in, first out, the newest units get sold first. So in this case, we go from the bottom and work our way up. So we sell 100 at 15, we sell 50 at 12, and the total cost is $2,100. That makes sense because you're selling the newest items first. Prices are going up, therefore the newest items are more expensive. So cost of goods sold under LIFO is going to be more at $2,100 than cost of goods sold at FIFO that's only $1,600. The flip side of that is what remains in ending inventory. So if FIFO, if you're selling the old, cheaper units, what's left in inventory is the more expensive units. So FIFO creates a higher ending inventory. What's left? LIFO, LIFO, on the other hand, we're selling the newer, more expensive units first. What's left in inventory are the cheaper, less expensive units. So with LIFO, ending inventory is lower. So you have to think about cost of goods sold and ending inventory in pair to understand the difference between LIFO and FIFO accounting for inventory.